You know, usually when we talk about a medical diagnosis, there's this built-in expectation of just like absolute precision. It feels like pure engineering.
Like totally.
Right, like you break your arm, the doctor puts you in the x-ray machine, the film comes up, and there is that undeniable jagged white line.
Yeah, it's a binary state.
Exactly. The doctor points at it, tells you it's a transverse fracture, and the path forward is immediately obvious.
The bone is broken, or the bone is intact. The visual evidence leaves zero room for interpretation.
Right. And as humans, we crave that kind of clarity. We want the things that dictate our well-being, whether that's our physical health or our financial health, to be visible, easily categorized, and just straightforward.
Yeah, but I mean, the second you step out of the doctor's office and into the world of investing, particularly when you start looking under the hood of publicly traded companies, you realize that the x-ray machine is, well, it's fundamentally broken.
It really is. We are navigating a financial landscape that is incredibly murky. You pull up a stock quote or glance at a headline number on an earnings release, and it confidently tells you one specific story.
But if you actually dig into the operational health of that company, the reality on the ground is often completely divorced from that headline.
Yeah, it is the absolute definition of financial muddy waters.
Oh, 100%. And this disconnect is never more pronounced than during corporate earnings season. You have these standardized accounting rules that dictate exactly how a company must report its net income.
Right, which we need.
Of course, those rules are necessary, to maintain a baseline of transparency,
right.
But they can also create these bizarre optical illusions.
Which is exactly what we're going to get into today.
Yeah, because the official, heavily regulated net income number can make a thriving company look like it is bleeding out on the operating table.
When in reality, the underlying operational cash flow is pumping with the strength of a marathon runner. And that murkiness, that optical illusion is exactly what we are dealing with today as we unpack the Q3 2026 numbers for Transcat.
Yes.
For those following along in their portfolios, the ticker symbol is TRNS. Welcome to another Talk Tickers deep dive, by the way.
Always good to be here.
So we're looking directly at the official earnings call transcript, specifically the commentary from CEO Lee Rudeau and CFO Tom Barbetto.
Right.
Our mission today is to take all of that dense, highly specialized Wall Street and accounting jargon, break it down into plain English, and figure out what the actual health of this business is.
Because as a retail investor, the reality is that you do not have a dedicated team of junior analysts sitting in a Manhattan high-rise, stripping out the accounting noise and feeding you a synthesized summary of what actually matters.
Right, you're mostly on your own.
Yeah, stock screeners and automated news alerts are just going to scrape the GAAP net income, flag it as a loss, and move on.
Yeah.
You have to understand the mechanics of the financials yourself to find a hidden value.
So let's start by contextualizing exactly what Transcat does. Because I have to admit, when you hear the phrase industrial calibration services, it does not exactly get the blood pumping.
No, it really doesn't.
It's not a hyper-growth AI software firm. It's not a consumer brand with some massive cult following.
It sounds like the kind of business that operates out of a windowless warehouse in a suburban industrial park.
Exactly. But for anyone managing their own money and looking for genuine stability, the recurring revenue engine hiding inside this seemingly mundane operation is, frankly, remarkable.
It is. Calibration is one of those invisible foundational industries. We never think about it as we go about our daily lives, but it literally holds the modern world together.
How so? Like, give us a real-world example of where this actually matters.
Okay, think about the manufacturing of a complex pharmaceutical drug. Say, a biologic that has to be fermented in a massive 10,000-liter bioreactor.
Okay.
The temperature inside that reactor must be maintained to an incredibly precise degree. The pressure must be exact. If the temperature gauge is off by a fraction of a degree, or if the flow meter measuring the active ingredients is slightly out of spec, an entire multi-million-dollar batch of life-saving medicine is ruined.
Or worse, it makes it to market and harms a patient.
Exactly. The tolerances are microscopic.
You can apply that same logic to the aerospace industry, right?
Oh, absolutely.
Like if a mechanic is using a torque wrench to secure a critical component on the wing assembly of a commercial airliner, that wrench cannot be applying 50 foot-pounds of torque when the dial says 60.
No, definitely not.
The cost of failure in these industries isn't just a slightly defective product. It is catastrophic loss of life and unimaginable liability.
And because the stakes are that high, these industries are governed by incredibly strict regulatory bodies. The FDA in pharmaceuticals, the FAA in aviation, the Department of Defense for military contractors.
Right, they don't mess around.
No, they do not just suggest that equipment is accurate. They legally mandate it.
So it's a compliance thing?
Completely. A pharmaceutical plant must have a documented, unbroken chain of evidence proving that every single instrument involved in the manufacturing process has been tested against a known, universally accepted standard.
Which is usually traceable to the National Institute of Standards and Technology, right? NIST.
Yes, exactly, NIST. So a company like Eli Lilly or Lockheed Martin can't just buy a thermometer or a pressure gauge, install it, and use it for 10 years.
They are legally required to continually test and validate that equipment.
And Transcat is the entity that provides that validation. They are the ones sending highly trained technicians into these facilities to certify that the equipment is telling the truth.
And that regulatory mandate is the entire thesis for the stock, isn't it?
It is. It creates a built-in, virtually unbreakable recurring revenue stream.
Because it's recession-proof, essentially.
Pretty much. If a mild recession hits, or if a company misses its quarterly earnings target and needs to tighten its belt, the executives cannot sit around a boardroom table and decide to skip their annual calibration cycle to save a few bucks.
Right, because if they do, they lose their compliance status.
Exactly. Their production lines are legally halted and their business shuts down. It is a strictly non-discretionary operating expense.
That sets the table beautifully for the actual Q3 2026 earnings numbers.
Yeah, let's get into the numbers.
Because when we look at the headline figures, the contrast between the operational reality and the accounting reality is, it's jarring.
It's very jarring.
If an investor simply opened their brokerage app and glanced at Transcat's profile the morning after this earnings call, they likely walked away very confused.
I mean, the top line paints a picture of aggressive, accelerating growth. Consolidated revenue for the quarter came in at $83.9 million.
Which represents a 26% increase year over year.
26%. In the context of industrial services, growing your total revenue base by more than a quarter in a single 12-month period is exceptional.
And digging a layer deeper, this wasn't empty revenue where they bought a bunch of unprofitable business just to pump up the sales figures.
Right, because you have to look at the profitability of that revenue.
Exactly. When you look at their adjusted EBITDA earnings before interest, taxes, depreciation, and amortization, it grew 27.2% to $10.1 million.
And they even squeezed out a 10 basis point margin expansion.
So let's unpack what EBITDA actually represents for the retail investor trying to understand cash flow.
Sure. So EBITDA strips away the financing decisions, like how much debt you carry. And it strips away the accounting decisions, like how you depreciate assets over time.
Leaving you with what?
It leaves you with the raw, pure operational cash engine of the business.
Okay.
So Transcat brought in 26% more revenue, and that core cash engine generated 27.2% more profit. The business itself, the actual act of calibrating equipment and renting out gear, is highly profitable and scaling efficiently.
And management also reported adjusted diluted earnings per share of 26 cents?
Right. So if the earnings release ended right there, the stock would likely gap up at the open. It's a textbook beat.
But you scroll down to the bottom line of the official income statement, and the company reported a GAAP net loss of $1.1 million.
Yeah.
GAAP, meaning generally accepted accounting principles. The most heavily regulated, standardized accounting framework in the United States officially declares that Transcat lost over $1 million this quarter.
And this is the exact moment where the muddy waters claim their victims.
Because people just read the headline.
A retail investor sees that net loss in bright red font, assumes the company is burning cash and failing to execute, panics, and sells out of a fundamentally strong position.
So the critical question we have to answer by looking at the call transcript is how a company can generate record revenues, pull in $10.1 million in pure operational cash flow, and still end up bleeding in the red on paper.
And CFO Tom Barbado spent a significant portion of his prepared remarks explaining this exact discrepancy.
He systematically walked through the non-operational, on-paper hits to the income statement.
Right, the net loss was driven by 3 specific factors, and honestly, none of them suggest that the technicians on the ground are losing their touch.
Okay, let's take them one by one. Factor number 1.
The first major anchor on GAAP net income was higher amortization expense. This is directly tied to their recent acquisitions of Martin Calibration and ESCO Calibration.
Which, just for context, Those two deals represent the largest acquisitions in the company's history.
Yeah, they were massive. And understanding amortization is crucial to understanding Transcat's real value here.
Break it down for us.
So when a corporation buys another company, they're purchasing physical assets, maybe some test equipment, a fleet of vans, an office building.
Tangible stuff.
Right. But the vast majority of the purchase price usually goes toward intangible assets.
Like what? They are buying the customer lists, the existing long-term contracts, the regional brand recognition.
And the assembled workforce of trained technicians, precisely.
Okay, so how does the accounting handle that?
The accounting rules require you to assign a monetary value to those intangible assets and place them on your balance sheet. But you can't just leave them there forever.
You have to write them down.
Exactly. GAAP requires you to slowly deduct the cost of those intangible assets from your profits over a set period of years. This process is called amortization.
So every single quarter, Transcat has to take a multi-million-dollar deduction on their income statement to reflect the quote-unquote using up of those acquired intangibles.
Yes. The critical distinction, and this is the most important part, is that amortization is a phantom expense.
Right. Transcat is not writing a check for that amortization this quarter.
Not at all. The actual cash already left the bank account when they closed the deals to buy Martin and ESCO months or years ago.
The current quarter's cash flow is entirely untouched by this accounting mechanism. It simply depresses the net income on paper.
It is entirely a paper phenomenon.
Okay, so that's factor one. What about factor two?
The second factor dragging down the GAAP net income is related to how they bought those companies. Increased interest expense.
Because they borrowed money.
Exactly. Transcat utilized debt to fund portions of the Martin and ESCO acquisitions. And, in the current macroeconomic environment, carrying debt means navigating significantly higher interest rates than we saw a few years ago.
Now, unlike amortization, interest expense is a real cash outlay. They are actually paying the bank.
They are, however, it is a financing cost, not an operational cost.
So it reflects how they structured the buyout, not how well they calibrate thermometers.
Right. It reflects the capital structure of the company, not the efficiency or profitability of the calibration services themselves. The underlying business is humming along, generating more than enough cash to cover that interest, but it does reduce the final net income figure.
Got it. And then we have the third factor, which is highly specific to this exact moment in the company's timeline.
The CEO succession plan.
Right. One-time charges related to finding a new boss.
Yeah, Lee Rudeau, who has led Transcat through a period of immense growth, is preparing to step down. The board of directors is actively executing a search for his replacement, evaluating both internal executives and external candidates.
And executive transitions are extraordinarily expensive.
Oh, unbelievably expensive. You have to hire specialized executive search firms, which charge exorbitant retainers. You often have to negotiate severance or transition packages for the outgoing CEO and prepare signing bonuses for the incoming one.
There are legal fees, consulting fees, administrative costs. It adds up fast.
But again, these are definitively one-time events. They are anomalous spikes in expenditure. You do not need to hire an executive search firm every quarter to keep the business running.
Right. It is a temporary burden on the income statement that does not reflect the long-term cost structure of running the calibration labs.
So when you aggregate those three things, the phantom accounting deduction of amortization, the financing costs of debt, and the anomalous executive search fees, you completely erase the $10.1 million of operational cash flow and drop into negative territory on paper.
I want to use an analogy here because wrapping your head around a business that is simultaneously printing cash and posting a loss is incredibly counterintuitive.
It really is. Please, go ahead.
It is almost exactly like buying a profitable rental property. Imagine you purchase a duplex in a strong rental market. You do your math, and between the two units, your tenants are paying you $3,000 every single month.
Okay, good cash flow.
Right. And your monthly mortgage payment, your property taxes, your insurance, and your estimated maintenance costs only add up to $2,000.
So operationally, the duplex is generating a positive cash flow of $1,000 a month. Your bank account balance is steadily rising by $12,000 a year.
Exactly. Your personal EBITDA on that property is highly positive. The cash engine works. But then April rolls around and you take your paperwork to a CPA to file your taxes.
And this is where the paper losses happen.
Right. The tax code allows you to deduct the depreciation of the building's physical structure over 27.5 years. Your CPA calculates the value of the building, divides it by 27.5, and takes a massive paper deduction against your rental income.
Which is the exact real estate equivalent of the amortization Transcat is taking on its acquisitions.
Furthermore, because you just bought the duplex this year, your CPA deducts all the one-time closing costs, the title search fees, the origination fees, the appraisal costs.
And those are analogous to Transcat's one-time CEO search fees.
Exactly. So by the time the CPA finishes applying the phantom depreciation and the one-time closing costs against your $12,000 of actual cash profit, your official tax return shows that the duplex operated at a net loss for the year.
On paper, you look like a terrible real estate investor who was losing money.
But if you open your checking account, you have significantly more cash than you did in January.
Right. And if you panicked and sold the duplex simply because the official GAAP equivalent tax document showed a loss, you would be making a disastrous financial decision.
You'd be selling a cash-generating asset because you misunderstood the accounting rules.
And that is the exact trap retail investors fall into with a quarterly report like Transcat's Q3.
Which is why we do this show.
Exactly. When CEO Lee Rudeau and CFO Tom Barbado point investors toward adjusted EBITDA, they are not engaging in sleight of hand.
They aren't trying to hide anything.
No, they are actively trying to show the market the true cash-generating reality of the duplex, stripped of the depreciation and the closing costs.
Once you understand that dynamic, you can set the GAAP net loss aside and focus on the actual growth engine.
Yeah, let's look at what's actually driving the growth.
We know the top-line revenue surged 26%, and we know the cash flow is highly profitable. The next crucial step is breaking down what actually drove that growth. Transcat is divided into two distinct operating segments, the service segment and the distribution segment.
The service segment is the core of the thesis. This is the army of technicians going into pharmaceutical plants and aerospace facilities to actually perform the calibration and validation work.
And overall, the service segment grew an impressive 29%.
Now, obviously, a large portion of that 29% comes from bolting on the Martin and ESCO acquisitions. When you buy two huge competitors, your revenue immediately spikes.
But the metric that truly defines the health of the company is organic growth, right? Like, how much did the core business, the labs and clients they already owned a year ago, grow on its own?
Yes. And the organic service growth for Q3 came in at 7%.
7% organic growth. Now, on the surface, if you are accustomed to looking at software as a service companies, 7% might seem, well, modest.
But we have to look at the historical context. During the call, Lee Rudeau proudly highlighted that Q3 marked Transcat's 67th consecutive quarter of year-over-year service growth.
67 consecutive quarters. You have to pause and mentally map out that timeline.
It is approaching 17 years of continuous, unbroken growth.
Every single quarter for nearly 17 years, they have generated more service revenue than they did in the same quarter of the previous year.
Think about what that streak survives. It survives the 2008 Great Financial Crisis, when global liquidity evaporated.
It survives the 2020 pandemic lockdowns when supply chains froze.
It survives the massive inflation spikes and aggressive interest rate hikes of the post-pandemic era.
It is one of the most compelling empirical proofs of a business moat you will ever find in the public markets.
It perfectly validates the earlier point about regulatory-driven revenue.
Because again, it's illegal not to pay them.
Right. When a recession hits, companies cut their marketing budgets, they freeze hiring, they delay upgrading their IT systems. But they do not stop calibrating their safety-critical equipment.
Because doing so is illegal.
The 17-year streak is the physical manifestation of that non-discretionary dynamic.
But the path to this 7% organic growth in Q3 wasn't entirely smooth, was it? If we look back at the earlier parts of this fiscal year, there was a noticeable sluggishness.
That's accurate. In Q1 and Q2, management acknowledged that they were seeing some delayed orders.
Why?
The broader macroeconomic uncertainty was causing some of their clients to push out discretionary spending, delay the launch of new manufacturing projects, or defer equipment upgrades.
But the crucial realization here is the nature of a delayed order in a regulated industry.
Right, it doesn't just disappear.
Exactly. When a semiconductor manufacturer delays building a new fabrication plant, the calibration work associated with that plant doesn't vanish into the ether. It just shifts to the right on the calendar.
The work remains a strict necessity. The timing simply changed. What the 7% organic growth in Q3 demonstrates is that the dam is beginning to break.
So the delayed orders are finally coming through.
Management noted a positive trend in the realization of those previously delayed orders. The coiled spring of deferred work is releasing, particularly in highly regulated, well-funded spaces like life sciences and the aerospace and defense sectors.
The clients can only delay their projects for so long before they have to execute.
Exactly.
So the service segment is steadily marching forward, absorbing acquisitions and maintaining its long-term organic growth streak. But when we pivot to look at the distribution segment, the numbers become truly eye-popping.
Yeah, the distribution side of the business involves providing the actual testing and measurement equipment to clients. Revenue here hit $30.2 million, which is a solid 20% increase.
But the metric that completely stole the show was the gross margin.
Gross profit in the distribution segment jumped 34%, and the gross margins expanded by 330 basis points.
Wow. In a mature industrial distribution business, seeing profit margins jump by 3.3 percentage points in a single year is a tectonic shift.
It indicates a fundamental change in how the business operates.
So how exactly did they achieve that? You don't just magically increase your profit margins by that magnitude by selling the exact same products the exact same way.
No, it was a highly deliberate, multi-year strategic pivot orchestrated by management. Roughly 18 to 24 months ago, they made a conscious decision to aggressively invest capital into their rental business.
As opposed to just selling the equipment outright.
Right. Historically, the distribution segment primarily operated on a traditional sales model. Transcat buys a highly specialized $15,000 piece of electrical testing equipment from a manufacturer, and they sell it to a contractor for $18,000.
They capture a fixed one-time margin, and the transaction is over.
But the rental model completely changes the financial physics of that piece of equipment.
Walk us through that.
Instead of selling that $15,000 testing unit once, Transcat retains ownership of it. They rent it out to a contractor for 3 months for $3,000.
Okay.
When the contractor finishes their specific project, they return the unit. Transcat recalibrates it, certifies it, and rents it to a different contractor for another project.
So over the 5-year lifespan of that piece of equipment, it might generate $30,000 or $40,000 in rental revenue.
Exactly. The upfront capital expenditure is higher because Transcat has to build the rental fleet, but the lifetime gross margin on each individual unit is exponentially higher than a one-time sale.
They transition from a transactional vendor to a recurring service provider, even on the equipment side.
And this strategic pivot to rentals just happened to collide with a massive, somewhat unexpected macroeconomic tailwind.
Which brings us to arguably the most fascinating strategic revelation in the entire transcript.
Yeah, during the Q&A portion of the earnings call, an analyst from Craig Palm, zeroed in on a specific end market that is driving this rental demand.
The AI and power infrastructure angle.
Palm astutely asked management about their positioning within the data center and power generation markets. The market is obsessed with the artificial intelligence boom, but most investors are entirely focused on the companies designing the semiconductor chips or writing the large language models.
Like NVIDIA or OpenAI.
Right. But those massive AI data centers don't run on software. They run on unimaginable amounts of raw electricity.
The physical reality of the AI revolution is a staggering demand for power infrastructure.
And at the exact same time, the country is attempting a massive build-out of electric vehicle charging networks, further straining the electrical grid.
Right.
So upgrading power generation facilities, installing massive power conditioning units for data centers, building new substations, all of this requires incredibly precise electrical testing and validation.
Because if the power flickers at a data center, it's a disaster.
Exactly. The contractors building this infrastructure need specialized equipment to ensure the power flow is stable, safe, and compliant.
And rather than buying hundreds of thousands of dollars of testing equipment for a 6-month substation build-out, those contractors prefer to rent the equipment.
And Lee Rudeau confirmed this dynamic on the call. He explicitly stated that Transcat is seeing significant accelerating demand for products used in power generation, power conditioning, and power management.
It is the ultimate picks and shovels play.
Yeah, like during a gold rush, the people who reliably make money aren't the prospectors panning for gold. It's the merchants selling the picks, shovels, and tents.
Transcat is not building AI data centers. They take zero risk on which software company develops the best algorithm.
Right. They are simply renting out the high-margin electrical testing shovels to the armies of contractors building the power grid that makes AI possible.
It's a brilliant, under-the-radar way to gain exposure to the most dominant macro trend in the market, wrapped inside a boring industrial services company.
It really is.
However, our job here is not just to celebrate the successes. We have to actively look for weaknesses in the armor. And there is a glaring inconsistency in this quarter's numbers that demands scrutiny.
The service gross margins.
Right. We just established that the service segment is the impregnable fortress of Transcat's business model. It has grown for 67 straight quarters. The organic growth is strong.
Yes.
Yet in Q3, the gross margins for the service segment actually declined. It cost them proportionately more money to deliver their calibration services this quarter than it did previously.
Which is a huge red flag if you don't know what's going on.
If demand is so robust and the moat is so wide, why are the margins compressing?
It is the single most important question a skeptical investor should ask, and Max Michaelis, an analyst from Lake Street Capital Markets, pressed management on it during the call.
And what was their answer?
Management attributed the margin compression to two specific words: startup costs.
Startup costs. In a tech company, startup costs might mean renting server space or buying software licenses. What do startup costs look like in the context of industrial calibration?
Okay, so when Transcat wins a colossal new enterprise contract, for example, taking over the entire calibration program for a multinational pharmaceutical manufacturer with facilities spread across 3 states, it is an incredibly complex logistical undertaking.
They cannot simply send a few technicians with toolboxes on Monday morning and start working.
The regulatory environment makes that impossible.
Right.
Before Transcat can generate a single dollar of optimized revenue from that new client, they have to navigate a massive onboarding process.
Like what?
They have to hire specialized technicians. They have to train those technicians for weeks on the specific proprietary nuances of that client's unique equipment.
That makes sense.
They have to integrate Transcat's calibration management software with the client's internal IT systems to ensure an unbroken digital chain of custody for the FDA auditors. In some cases, Transcat even builds out physical climate-controlled calibration lab spaces directly inside the client's manufacturing plant.
Wow. So they're essentially building a customized micro business for every major new enterprise client.
Exactly. They are incurring heavy upfront labor and infrastructure costs before the revenue stream reaches its steady state.
And Lee Rudeau was very direct about this philosophy, right?
He stated that getting off to the right start with these massive new clients is their absolute highest priority. They willingly absorb a short-term hit to their gross margins to ensure the onboarding is flawless.
Why?
Because the lifetime value of these enterprise contracts is astronomical.
They aren't trying to squeeze every last penny out of the first quarter of a relationship.
Yeah.
They are securing a partnership that could last a decade or more.
Right. And Rudeau actually provided a historical parallel to reassure the analysts. He referenced a previous major onboarding event, referring to it as the CBL's integration.
What happened during that integration?
He reminded the market that during that specific integration, Transcat experienced the exact same phenomenon. A temporary dip in gross margins due to heavy upfront labor and training costs, followed by a steady normalization over the subsequent quarters as the new technicians gained efficiency, the workflows moved out, and the revenue optimized.
So if we translate management's explanation, this margin compression is not systemic decay.
No, it is not a sign of increasing competition forcing them to lower their prices.
It is the cost of digestion. The company just ate a massive meal of new enterprise contracts, and the short-term margin hit is simply the metabolic cost of digesting that new business into the recurring revenue engine.
That is the argument management is making. And given their track record of the last 17 years, the institutional market is generally willing to extend them the benefit of the doubt on their execution capabilities.
Which perfectly bridges the gap to our next major area of analysis: management guidance and long-term catalysts. We know the historical context, we understand the 26% top-line surge, and we've diagnosed the temporary service margin dip.
Right.
What exactly are Lee Rudeau and Tom Barbato telling Wall Street to expect in the immediate future and over the next several years?
So, looking at the immediate horizon of Q4, management reaffirmed their guidance, projecting high single-digit organic service revenue growth.
They remain highly confident that the momentum built in Q3 will sustain itself through the end of the fiscal year.
And crucially, Barbato addressed those depressed service margins. Will the digestion phase end?
What did he say?
He specifically pointed out that historically, Q4 is always Transcat's strongest quarter for margin performance. To put it in perspective, in Q4 of the previous year, their service gross margins reached a phenomenal 36.2%.
36.2% is massive.
It is. His explicit expectation is that the heavy onboarding and startup costs incurred in Q3 will begin to roll off and normalize, paving the way for significant margin expansion as they close the books on the year.
So the short-term message to the market is clear. Steady, high, single-digit revenue growth, coupled with a sharp rebound in profitability.
Yes, but the earnings call did not stay focused on just the next 3 months.
No. Ted Jackson, an analyst from Northland, zoomed out and initiated a discussion about the macro-level tailwinds driving the entire industry.
And this segment of the call offered the most compelling vision for long-term, buy-and-hold investors.
Jackson specifically highlighted the massive, unprecedented onshoring of pharmaceutical manufacturing back to the United States.
He rattled off a list of staggering capital expenditures currently underway. Eli Lilly alone is deploying $30 billion to build new state-of-the-art manufacturing facilities in Alabama, Pennsylvania, Texas, and Virginia.
AstraZeneca has publicly pledged a $50 billion investment in U.S. infrastructure. Amgen is breaking ground on new plants.
It's a gold rush.
And we have to remember the catalyst for this. During the supply chain collapses of 2020 and 2021, the U.S. government and these massive pharmaceutical conglomerates realized they were dangerously dependent on overseas manufacturing for critical life-saving drugs.
The strategic vulnerability was unacceptable. As a result, they are repatriating the manufacturing base. They are building the infrastructure domestically.
So Jackson's fundamental question to management was straightforward. Does this historic wave of domestic capital expenditure create a massive multi-year tailwind for Transcat's core business?
And Lee Rudo's response was definitive. He essentially stated that any onshoring of manufacturing in highly regulated spaces is a permanent structural advantage for Transcat.
But what was truly eye-opening was how he described Transcat's immigration to these projects. They don't just wait for the plant to be finished and then offer to calibrate the thermometers.
No, they embed themselves into the entire life cycle of the multi-billion-dollar build-out. Let's walk through that life cycle. When a company like Eli Lilly announces a new $5 billion biologic plant, the construction phase begins. Transcat is positioned to provide the high-margin rental equipment necessary to test the electrical and environmental systems as the physical plant is being built.
Then comes the commissioning phase.
Right. The manufacturing equipment is installed. Transcat can step in to perform the initial installation qualification and operational qualification, proving to the FDA that the equipment was installed correctly and operates as designed before a single drop of medicine is produced.
And finally, they secure what Rudo referred to as the brass ring.
Yes, the ongoing recurring revenue. Once the plant is validated, commissioned, and actively producing pharmaceuticals, every single instrument in that facility requires strict ongoing calibration on a set schedule.
So Transcat locks in the recurring maintenance contract, securing a high-margin revenue stream that will persist for the entire multi-decade lifespan of the facility.
It is a brilliant strategy. They monetize the construction, they monetize the validation, and then they capture the perpetual annuity of the ongoing calibration.
And this onshoring dynamic is not isolated to life sciences. Jackson also pointed to the defense sector.
He cited the impending $1.5 trillion in federal defense spending. Major defense prime contractors like Lockheed Martin and Northrop Grumman are massively increasing their capital expenditure budgets, in some cases by 30% or more, to meet the geopolitical demand for advanced weapons systems and aerospace platforms.
Now, a skeptic might argue that companies as massive as Lockheed Martin surely have their own internal calibration laboratories. Why would they outsource that critical function to a company like Transcat?
Rudo addressed that exact dynamic. It is true that the massive prime contractors maintain internal calibration capabilities. However, when defense spending surges and production ramps up aggressively, those internal labs simply cannot handle the volume.
They become bottlenecks.
Precisely. And Transcat acts as the pressure relief valve. They step in to handle the overflow.
How does that look in practice?
They will calibrate the contractor's internal master standards, or increasingly, Transcat will deploy its own technicians directly onto the floor of the Lockheed Martin plant to work alongside the internal team.
A massive influx of defense spending directly correlates to more equipment on the factory floor, which inexorably leads to a higher volume of required calibration.
Yes.
So synthesizing all of these massive macroeconomic drivers, $30 billion from Eli Lilly, the $50 billion from AstraZeneca, the $1.5 trillion in defense spending, the massive power infrastructure required for the AI data center boom, it naturally leads to a speculative question.
Oh, for sure.
If the wind at Transcat's back is a Category 5 hurricane of domestic capital expenditure, is it possible that their historical 7 to 8% organic growth rate permanently accelerates? Could this reliable single-digit grower fundamentally transform into a business that consistently generates double-digit organic growth?
It is the most logical question an aggressive investor could ask, and it is exactly where management demonstrated an impressive level of restraint and discipline.
Rudeau openly acknowledged that Transcat certainly experiences specific quarters where organic growth breaks into double digits. However, he was resolute in maintaining their official long-term guidance of high single-digit growth.
It's refreshing. In an era where CEOs are constantly hyping their long-term projections to juice the stock price, Rudeau actively managed expectations downward.
Why not promise Wall Street double digits if the macro tailwinds are that strong?
Rudeau explained it mathematically. It all comes down to the law of large numbers. He reminded the analysts to look at the base denominator. Back in 2011, Transcat's total service business was generating roughly $30 million in revenue.
Growing a $30 million business by 10% requires generating $3 million in net new business over the course of a year,
which is entirely manageable for a competent sales team. But today, the reality is entirely different. The service business is currently operating at an annualized run rate of over $230 million.
Right. To organically grow a $230 million base by 10%, Transcat has to go out and secure $23 million in net new calibration contracts every single year just to maintain the percentage growth rate.
The sheer volume of new business required is exponentially higher.
So management's message is essentially, do not view high single-digit growth as a disappointment or a deceleration. Maintaining an 8 or 9% growth rate on a massive $250 million base requires a staggering amount of execution.
It's a major operational victory disguised as a conservative forecast.
And because the organic growth becomes mathematically harder to accelerate as the base expands, management heavily relies on their second avenue for expansion, their M&A roll-up strategy.
Right. If you can't grow fast enough organically, use your capital to buy inorganic growth. Transcat is constantly looking for strategic bolt-on acquisitions.
They aren't trying to buy massive transformative companies every quarter. They are looking for smaller, successful regional players to fill specific geographic voids in their national footprint.
And on the call, they were remarkably transparent about their current geographic targets. They specifically stated they are actively seeking acquisition targets to establish or expand their physical presence in Northern California, Dallas, Atlanta, and the Mid-Atlantic region centered around Baltimore.
If you look at that list of cities, the strategy is obvious. Northern California is the heart of the tech and biotech sector. Dallas and Atlanta are exploding with industrial manufacturing and corporate relocations.
The Baltimore corridor is heavily saturated with defense contractors and federal research labs. They are actively hunting for acquisitions in the exact geographies where their macro tailwinds are strongest.
They also highlighted their recent expansion into Ireland. That might seem out of place for a U.S.-centric company, but it is a highly calculated move.
Ireland is a massive global hub for pharmaceutical manufacturing due to favorable tax structures. By establishing a foothold in Ireland, Transcat can follow its massive multinational U.S. pharma clients across the Atlantic and service their European facilities.
The mechanics of the roll-up strategy are incredibly efficient. When Transcat buys a well-respected, family-owned calibration lab in Dallas, they instantly acquire that lab's regional book of business and established customer relationships.
But they also acquire a brand new distribution channel. They can immediately cross-sell their high-margin equipment rentals to those new Dallas customers, rapidly increasing the profitability of the acquired business.
It's a textbook synergy play, and they have proven they know how to execute it over the last decade. But executing an aggressive acquisition strategy requires capital. It requires a pristine balance sheet.
Which brings us to the crucial final phase of our analysis, the bottom line.
Right. We understand the revenue drivers, the margin dynamics, and the long-term strategic roadmap. Now we must evaluate whether Transcat has the financial foundation required to actually execute this ambitious plan. Let's look at the balance sheet health.
CFO Tom Barbetto reported that total debt currently sits at $99.9 million.
At first glance, carrying nearly $100 million in debt in a macroeconomic environment characterized by elevated interest rates might raise an eyebrow for a conservative investor.
The debt load is primarily the lingering result of financing those two massive transformative acquisitions, Martin Calibration and ESCO.
Correct. But analyzing raw debt numbers in a vacuum is useless. You have to measure the debt relative to the company's ability to generate cash.
Right, because Transcat's core EBITDA was so robust this quarter, jumping 27% to over $10 million, they were actually able to sequentially reduce their leverage ratio.
Barbado noted that their leverage ratio is now down to 2x.
A leverage ratio of 2x, meaning total debt equals 2 times the annualized EBITDA, is generally considered highly manageable, particularly for an industrial services company with a 17-year track record of unbroken recurring revenue.
Mathematically, it means that if Transcat dedicated every dollar of its core operational cash flow to debt reduction, assuming zero taxes or capital expenditures, they could entirely pay off their debt burden in exactly 24 months.
The cash generation engine easily outpaces the debt burden. And perhaps more importantly for their M&A strategy, Barbado highlighted that they still maintain $50.1 million in available capacity on their secured revolving credit facility.
That $50 million represents pure dry powder.
It provides management with tremendous financial agility. If the perfect, highly coveted acquisition target in Atlanta or Dallas suddenly becomes available tomorrow, Transcat does not have to go to the public markets, issue a massive secondary offering of new stock, and dilute their current shareholders to fund the deal.
They have the immediate liquidity required to pull the trigger and execute the buyout.
The balance sheet is solid, the strategy is clear, and the macro tailwinds are forceful. However, there is one significant looming variable that introduces a degree of uncertainty into the near-term narrative.
It is a pending catalyst that investors must factor into their risk models.
The CEO transition.
Yes. Lee Rideau has undeniably overseen an incredible era of wealth creation and strategic expansion during his tenure, but he is retiring.
Barbado provided a brief update on the search process, noting that the board's committee is actively evaluating a slate of both internal executives and external candidates. He indicated that the process is nearing its conclusion and that the market should expect clarity on the new leadership by Q4.
Whenever a successful CEO departs, it automatically introduces execution risk. An investor must acknowledge that a new chief executive, particularly if hired from outside the company, might arrive with a mandate to pivot the corporate strategy.
They might alter the criteria for M&A targets, restructure the internal management hierarchy, or aggressively change the capital allocation priorities.
Beyond the strategic uncertainty, there is a guaranteed financial impact. Barbado explicitly warned analysts that the company will incur additional significant one-time expenses tied to concluding the search.
Which means investors need to mentally prepare for the Q4 earnings report. Even if the calibration business crushes its revenue targets and margins expand beautifully, the official GAAP net income might look ugly again.
There will be final payments to the executive headhunters, severance accounting for the transition, and potentially massive signing bonuses for the new executive. The accounting noise will persist for at least one more quarter.
So, we have thoroughly mapped the muddy waters. Taking all of this detailed analysis into account, the GAAP loss versus the cash flow, the margin dynamics, the macro tailwinds, and the looming CEO change, what is your definitive, opinionated position on Transcat's Q3 results?
Let's hear it.
Despite the initial shock of the GAAP net loss, and despite the inherent uncertainty of a leadership transition, I view this quarter as a fundamentally and aggressively bullish signal for long-term investors.
Walk us through the conviction behind that position.
The conviction rests entirely on the integrity of the core thesis. The 17-year, 67-quarter streak of uninterrupted service growth is empirical evidence that their regulatory-driven recurring revenue model is virtually bulletproof against normal economic cyclicality.
It's hard to argue with a 17-year streak.
Furthermore, the massive macro tailwinds of pharmaceutical onshoring and defense modernization provide a multi-year runway of accelerated demand.
And finally, management is proving they can execute a highly complex, highly profitable pivot in their distribution business by aggressively scaling equipment rentals.
The underlying cash engine is stronger than it has ever been.
So for the retail investor listening to this deep dive who is either currently holding TRNS stock or actively considering initiating a position, what is the actionable takeaway? When the Q4 earnings report drops in 3 months, what specific metrics must they scrutinize to validate or invalidate this bullish thesis?
There are 2 critical, non-negotiable items to watch in Q4. First, you must immediately check the service gross margin metric.
Management explicitly promised that the heavy onboarding startup costs incurred in Q3 would roll off, and that Q4 margins would bounce back significantly, trending toward the mid-30s.
Investors must demand execution on that promise. If the service margins remain depressed in Q4, that is a massive red flag, indicating that these costs are structural, not temporary, and the margin profile of the business is degrading.
The classic principle. Trust management's explanation, but rigorously verify it with the next quarter's data.
Exactly. The second crucial item is the announcement of the new CEO. Pay close attention to the profile of the hire.
If the board elevates an internal candidate, the market will likely interpret it as a signal of strategic continuity, a commitment to maintaining the current operational playbook.
However, if they hire an external executive, particularly someone without a deep background in highly regulated industrial services, investors must scrutinize their initial communications to ensure they fully grasp the nuanced, compliance-heavy nature of Transcat's moat.
To synthesize this expensive talk tickers analysis into the core, actionable takeaways for your portfolio. Number 1, do not be deceived by the GAAP net loss. The core operational business generated exceptional double-digit revenue growth and expanding cash flow.
Number 2, the strategic shift toward renting high-value testing equipment rather than selling it is driving massive margin expansion in the distribution segment.
Number 3, Transcat is perfectly positioned to capitalize on massive, high-conviction macro tailwinds, specifically the repatriation of U.S. pharmaceutical manufacturing and escalating defense budgets.
And number 4, the temporary compression in service margins appears to be a calculated, worthwhile investment in onboarding massive new enterprise clients that will generate recurring revenue for years to come.
It is the ultimate case study in why retail investors must go beyond the stock screener, read the actual transcript, and understand the mechanical reality of the business model.
It truly is.
And before we conclude this deep dive, I want to leave you, the listener, with a completely different thread to pull on as you think about the future of this industry.
Let's hear it.
We've spent a lot of time discussing the physical realities of calibration technicians turning wrenches, measuring fluid dynamics in bioreactors, testing electrical grids. It is a highly manual, human, labor-intensive process governed by rigid physical standards.
The entire business model is predicated on the necessity of a human expert verifying a physical instrument.
Exactly. But consider the rapid exponential advancements occurring in the field of quantum metrology and artificial intelligence.
Oh, wow. Okay.
We are entering an era where sensors can utilize atomic-level physics to achieve levels of precision previously thought impossible. What happens to the industrial calibration industry when instruments become so advanced and infused with such powerful AI that they can continuously, autonomously self-calibrate in real time?
It fundamentally challenges the core necessity of the human technician.
Right. If a bioreactor's internal sensors use quantum entanglement to guarantee absolute temperature accuracy without ever drifting out of specification, the physical act of calibration becomes obsolete.
That's a wild thought.
So the provocative question for Transcat's long-term future is this. As the physical mechanics of measurement give way to quantum physics and algorithmic self-correction, can Transcat successfully pivot from being an army of physical mechanics to becoming an elite software and algorithmic auditing firm, verifying the AI that controls the sensors?
Will their regulatory moat protect them from the obsolescence of the very physical instruments they built their empire calibrating?
It forces you to question whether the moat is built on regulatory compliance or the physical limitations of current technology.
It's a fascinating dynamic to monitor over the next decade.
Thank you for joining us on this exhaustive Talk Tickers deep dive into Transcat's Q3 numbers. We hope this breakdown has equipped you to translate the jargon, ignore the accounting noise, and identify the true narrative hiding inside the cash flows. Keep questioning the headline numbers, keep digging into the mechanics of the businesses you own, and we will see you on the next deep dive.